I'm Liz Raphaely with Prudent Management Associates, and I'm here with my colleague and our firm's investment director, Daniel Berkowitz. Dan, great to have you. So you've summed up this year's markets with the phrase, bright returns under cloudy skies. What's behind that phrase?
Yeah, thanks, Liz. So it's great to be here. The phrase is really a reference to all of the uncertainty that investors have experienced in the markets this year, whether it's rising geopolitical tension, still evolving inflation story, a potential AI bubble. So there's a number of clouds or risks on the horizon that we're paying attention to. But even if you take the choppiness out of the markets that we experienced over the last week, I think returns have been really strong across a broad array of financial asset classes this year. U.S. equities, international equities in particular, fixed income. And so I guess to continue with the metaphor, even if the market forecast is gray or cloudy, returns can still surprise us.
Yeah, I think a lot of people are pretty surprised about that right now, especially given the headlines recently. How are returns staying so strong given these rough headlines?
Yeah, it's a good question because the data and the sentiment aren't always in sync. So several forces are at work here. For starters, the U.S. economy has remained more resilient than many predicted. Corporate earnings have held up well, consumer spending has remained strong, and inflation, although still elevated, is well below the peaks of 2022. And unemployment rates, while not at historic lows anymore, are still relatively healthy. So what's really important to remember is that markets are forward-looking. Investors are constantly trying to anticipate what's going to happen in the next 6 to 12 months, not just react to today's headlines. And so while the world feels uncertain, markets are betting on eventual policy normalization, possibly even rate cuts next year, and continued corporate adaptability.
Yeah, that's a great point, Dan. Let me put some numbers to that. If you take a simple 60-40 portfolio composed of U.S. equities using the S&P 500 and U.S. bonds using the Bloomberg U.S. Aggregate Bond Index, it's returned around 11% through November 21st. And that's even with the modest sell-off we experienced recently. That's impressive in any year, but especially when you consider what investors have had to process recently.
Yeah, then let me just add a little bit of perspective. I guess you and I were sitting here in January or in April after the tariffs were announced and someone gave us a list of all the things that were going to unfold this year through the fall. I don't think you and I would have written down 11% as a potential expected rate of return for investors in a balanced portfolio. And so the point here, I guess, is that markets don't necessarily need perfection. They really just need to continue grinding higher, things to be better than expected or better than consensus or what's priced in. And I think by and large, that's what we've experienced this year.
Right. Dan, what about the volatility in the last few weeks? In a short period in November, the S&P 500 index dropped around 3.5%, and there's a lot of talk of AI bubbles and the economy slowing. Could the gains the market has experienced in this year, I guess, be erased by the coming weeks?
It's definitely been choppy, Liz, as you pointed out recently, but we don't believe that we or really any investor can make kind of meaningful and short-term predictions about the markets over a couple weeks or a couple months. But there certainly are risks on the horizon that are important that our investment committee is focused on. So there's three in particular. I'll talk about the first is equity market concentration and valuations. So right now, the 10 largest companies in the S&P 500 make up roughly 35 to 40% of the index. What that really means, for all intents and purposes, is that a handful of companies are driving a disproportionate share of what happens in the markets. And if a few of them start to struggle, they can pull the whole market index down. And even more, these 10 large companies happen to be mega cap technology companies that are great businesses. They're really profitable. They've delivered outsized returns since really the global financial crisis. So they're trading at very rich price multiples or valuations at this point, which has its own implications for what their forward-looking return prospects are. But the companies themselves are right now spending enormous amounts of money on capital expenditures for artificial intelligence, the infrastructure build-out. And I think what we're seeing in the markets right now is investors are increasingly starting to question whether those expenditures are going to deliver sufficient profits in the future to support those high valuations. The second thing we're watching closely is tariff levels, of course. There's a really wide variation in potential outcomes here. We and the markets are eagerly awaiting a ruling from the Supreme Court, which may provide some short-term clarity. But even if we look out ahead past President Trump's term, future administrations can either double down on these protectionist policies or they can reverse course entirely. And so that uncertainty can create a ripple effect for businesses that makes it really difficult to plan and also, factor into financial markets. And so finally is one longer term risk that we're paying attention to is U.S. fiscal policy. So our debts and our deficits are on an unsustainable trajectory. We all agree. And Congress has very little political will to rein them in at this point. So what that may ultimately do is put upward pressure on U.S. interest rates. And I think that also hamstring the government's ability in the future to respond fiscally to any future market shock that we have, like, for example, COVID in 2020. Right. And so that has profound implications for the markets and economy. So those are three things that we're paying close attention to.
We typically mention that risk is necessary for return, which is one of the foundational principles of investing. You simply can't earn meaningful returns without assuming some level of uncertainty. It's basically the price of admission. And the goal isn't to eliminate the risk, it's to understand it, price it, and manage it intelligently.
One last thing I'll mention is that, year end, always a great time to take a look at your portfolio. We all have a little more time to spend with friends and family. And so investors should take a step back and think to themselves, is my portfolio still aligned with my goals, my risk tolerance, my time horizon, any other unique needs that I have? And if the answer to those questions is yes, I think that's great. Perhaps maybe add a few of the defensive tweaks that we just spoke about, but otherwise I think folks are in good shape. So always a great time to do a portfolio checkup at the end of the year.
I agree, Dan. The reality is we're always investing and living under partly cloudy skies. There's never going to be total clarity in the markets or in life, but with a smart and steady plan and a long-term mindset, you can still see those bright spots. Dan, as always, thank you for the insight and clarity.
Yeah, thanks for having me.